Hi. Let's learn about derivatives. A derivative is a type of financial contract whose value depends on an underlying asset, group of assets, or benchmark. It can be traded on an exchange or over the counter. Derivatives are used to hedge against risk or speculate on the price movement of an underlying asset. Derivatives are complex financial securities that allow traders to access specific markets and trade different assets. The most common underlying assets for derivatives are stocks, bonds, commodities, currencies, interest rates, and market indexes. Derivatives can be used to hedge a position, speculate on the directional movement of an underlying asset, or give leverage to holdings. Derivatives were originally used to ensure balanced exchange rates for internationally traded goods. Derivatives can be used to hedge currency exchange rate risk, interest rate risk, and the risk of default on loans or cash flows from other business activities. However, it's important to remember that OTC-traded derivatives generally have a greater possibility of counterparty risk, which is the danger that one of the parties involved in the transaction might default. There are two classes of derivative products, lock and option. Lock products, such as futures, forwards, or swaps, bind the respective parties from the outset to the agreed-upon terms over the life of the contract. Option products, such as stock options, offer the holder the right, but not the obligation, to buy or sell the underlying asset or security at a specific price on or before the option's expiration date. A futures contract is an agreement between two parties for the purchase and delivery of an asset at an agreed-upon price at a future date. Futures are standardized contracts that trade on an exchange. They can be used to hedge risk or speculate on the price of an underlying asset. Not all futures contracts are settled by delivering the underlying asset, many are cash-settled. Forward contracts are similar to futures, but they do not trade on an exchange. These contracts only trade over the counter and carry a greater degree of counterparty risk for both parties. Once created, the parties in a forward contract can offset their position with other counterparties, which can increase the potential for counterparty risks as more traders become involved in the same contract. Swaps are used to exchange one kind of cash flow with another. They can be used to switch from a variable interest rate loan to a fixed interest rate loan, exchange currency exchange rate risk, or the risk of default on a loan or cash flows from other business activities. However, swaps also carry counterparty risks, which are the risks that the parties involved may not be able to live up to the obligations outlined in the contract. An options contract is an agreement between two parties to buy or sell an asset at a predetermined future date for a specific price. The buyer is not obliged to exercise their agreement to buy or sell. Options can be used to hedge or speculate on the price of the underlying asset. However, as with other derivatives, options contracts are also sensitive to market risks and counterparty risks. Derivatives can be a useful tool for businesses and investors to hedge risk, speculate on price movements, and leverage their positions. They can often be purchased on margin, making them less expensive to acquire. Derivatives are difficult to value and are sensitive to market sentiment, making them vulnerable to market risk. They are also usually leveraged instruments, which means that while they can increase the rate of return, they also make losses mount more quickly. Derivatives are securities whose value is derived from an underlying asset. Derivatives can be a convenient way to hedge risk, speculate on price movements, and leverage positions. However, they also carry counterparty risk, the inherent risks of leverage, and can lead to complex webs of derivative contracts. Here are two key takeaways. 1. Derivatives are financial contracts, set between two or more parties, that derive their value from an underlying asset, group of assets, or benchmark. 2. Derivatives can be a useful tool for hedging risk, speculating on price movements, and leveraging positions, but they also carry inherent risks, including counterparty risk and market risk. Hope this would help. Thanks for watching.